Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We get into on a daily basis what drives mortgage rates on any given day, and sometimes it could be something from the economic calendar, it could be something from headline news, or even geopolitical. And also sometimes good news is now bad news as the market sentiment changes, and we get a lot of these quick fluctuations of the markets, and somebody on the sideline may wonder what's going on here. And what we try to come out with explanations for you folks to hopefully help you guys out here. A little bit about myself is I'm a loan officer. I do work with the national lender. We do loans in all 50 states, so we certainly help a lot of people in with their purchasing as well as the refinance needs. So if you need something, either of those categories, we'd love to be able to help you guys out. So please reach out. But we're also here as a resource for you folks to act as hopefully give you the information you're seeking, whether it's something about mortgage rates or something about mortgage programs that could be available out there, uh, or even other questions that maybe you have that may be related, we can answer for you guys. Just please feel free to reach out. Best way to reach us is on those social media sites that you found us on, and we will certainly be in touch. So without further ado, why don't we jump right into it? We'll start off with the economic calendar. And if you've been following my past videos, we've been talking about today is the big day in terms of for this week. It's been a light week in terms of economic data, but we do got two very important ones, but one extremely important one, which is the CPI report, which is the Consumer Price Index. And this is one of the two uh, inflationary for consumer, and we've been waiting for it. So we'll start off with the core CPI, which is when you exclude food and energy. It went up back in December. It went up 0.6%. Forecast was cut for 0.5%, and it continued that same trend at 0.6%. Now its counterpart, the headline news, the consumer price index. Uh, December's number was revised higher from 0.5% to 0.6%, and and a forecast of 0.5%, and it continued its trend at 0.6% as well. Now here's the year over year. So here's the headline CPI. It went from 7% to 7.5% when we had a forecast of 7.3%. The core CPI, core CPI went from 5.5% December with a forecast of 5.9, and it exceeded that to 6%. These are the hottest readings we've had since 1982 when the Volcker started raising rates all the way up to like 18%. So this is what's with the inflation getting out of control, and this is why we're the talk about why inflation's on the forefront right now. Not so much jobs, but inflation is the forefront of what we're looking at and how the Fed's going to react. Now, with this data, basically, it's basically increased the chances of a March rate hike to 0.5%. Uh, we'll touch on a couple other little things here shortly, but this basically what this did was it basically increased the odds of that the Fed will raise rates instead of the normal increments of 0.25%, that they'll even increase it further to 0.5%. Part of the being is that when they do a rate hike, we don't feel it immediately. It usually takes a good 6 months for it to kind of kick into the economy. So to do it sooner than later is fairly important in this scenario here. Now, let's continue with our economic data. We got basically one more item here, and that's the jobless claims. So these come out every Thursday, so every week. So last week's report was revised slightly higher from 238,000 to 239,000, and the forecast was calling for 230,000. It came in slightly under at 223,000. So we're still not bad, but not great either in terms of jobless claims. And if you look at the continuing claims basically remained unchanged because last week's report basically was revised a little bit lower, and that same number is what we have today. So it remains unchanged in terms of one week to the next on continuing claims here. Now, to touch on some of the headline news we talked about, this was the big one. We do got some current earnings reports, but again, the inflation data is what was really important. But we also got a few Fed speakers. Uh, we've been getting some mix. You know, we had a non-member talking about how he's in favor of quarter basis points, maybe about 3 hikes, uh, and then reducing the balance sheet. But we've also had a few others that were basically, depending on the market, but they would favor 0.5 point and even more rate hikes for the year. So some investors think there could be 6 or 7 rate hikes this year coming up here. Now, there's the market was bad, but it got even worse after Bullard's comments here. He's a Fed member and he's a voting member. One of his I'll just touch on here is that he's in favor of 100 basis points, which translates a 1 point lead, so 1% in the interest rate increase by July. So that means we have a few meetings that he thinks we should be up to 100, up to 1%, basically. Now he also favors a first half point in U.S. rate increase since basically 2000. So he's in favor of that half a point increase, is what they're saying for the March increment there. Now let's take a look here. So we were down probably about 60 basis points or so, and we lost probably almost a quarter basis points after we made the comments. But as you can see, within just a couple minutes, it just subsided back to 64, down to about 64 basis points. Here's the volatility of here. It dropped dramatically after that came down, kind of stayed sideways, and then went down some more, went sideways. And then after Bullard made the comment, dropped dramatically even further. And then we had some of this little, just within the last few minutes here, subsided here as we're talking. So currently we're down about 63 basis points to get in there. And as you can see here on the yields, we hit that 2% threshold. We talked about that before. It was just a matter of time. Once we broke above that 190, that we're going to hit that one. Right now we're just above at just under 2.03 basically percent. So it looks like we've hit that number here. So what does that mean? Well, higher rates. We've had several price changes so far this morning. As as you can see here, we've had several going in there. So as a result there, so a lot of lenders have been repricing for the worse. We've had again a couple pricing changes as of this morning. So our rate sheets today would definitely not look like anything like yesterday's, and it'll be a bit worse than yesterday's on there. So you can figure a no point loan from yesterday could be either it'll cost you 1/2 to 3/4 of a point today, based on those numbers here. All right. Wish I could have brought better news for you folks, but unfortunately, it is what it is. We've been expecting rates to come rise over time, but unfortunately, sometimes we get these big stops where we'll have these big spurts where it just quickly spirals downwards, and then we'll get a little bit of correction. We'll come back a little bit where we'll see some improvement, and then it'll worsen again. So unfortunately, that's the way the markets run. Now, lastly, we'll cover the average rate for conforming loan limits. Now, these do have points built into them. So we'll start with the 30-year fix, which is up to a 3.9 now. And then we got the 15-year at 3.16 right now. So again, real volatile today. We did predict that there would be some volatility here, and a lot of people did. Most people felt that it could be a pretty high number with it, but it was just a matter of where we priced in where we should be at or not, and apparently we're not. We weren't priced in for the numbers that we were expecting coming in here. Excuse me. All right, folks. You guys have a great rest of your day. We appreciate you guys. If you guys like these videos, please help us out. Smash that like button. We greatly appreciate it. And share us. Thank you very much for your time and time to watching. And we'll look forward to see you guys in tomorrow's video. Have a great rest of your day. Bye-bye.